Hi, this is Kevin Gormley, a CPA that does financial planning. And today I wanted to talk about why Tennessee loves your investment choices, or a subheading of how come I have to pay Tennessee tax on investments when I heard there's no income tax. Well, first of all, I must say, lived in Tennessee, I don't know, 14 out of the last 15 years, maybe 16 out of the last 17. I don't know the exact time period, but I can tell you that our family just loves Tennessee. This is hopefully our last stop on our journey. We love the state of Tennessee. But being somebody that specializes in financial planning and tax planning and looks at the investments, I can tell you that Tennessee has very unique properties when it comes to taxing income. Okay, so the first thing people hear is that they hear that Tennessee has no income tax. And that is somewhat true. What's true is that if you work at a job and you earn income, called earned income, Tennessee does not tax that. But if you have investments, Tennessee will tax it. And so today I wanted to talk about what kind of income gets taxed by Tennessee and what can you do to lower the amount of Tennessee tax that you pay, because there's ways to do it. So I'm going to pause it for a second and then show you the different ways that Tennessee taxes income. So first, let's discuss what a capital gain is, because Tennessee has a very important nuance in capital gains. So a capital gain tax happens when you what? When you sell something at a higher price than you buy it. Okay, you have a capital gain. You buy low and you sell high. That's called a capital gain tax. Tennessee does not tax this. Okay, the big problem we have with the Hall tax is that there's something else called a capital gain distribution, which you don't have to buy and sell anything, and yet Tennessee still picks this up on the tax return. Okay, so this is from the Hall tax PDF, and before you click off, I'm only going to show you one thing, I promise. I'll also send this PDF with this video if you want to check this out. But the only thing I want to show you is income from investment trusts and mutual funds, including capital gain distributions. Okay, so we see the words capital gains here. This is not capital gains. It's capital gains distribution, and I'm going to show you one tax form. Don't click off. I promise. It'll be quick. Might be a little painful, but this is the most important thing for you to realize about Tennessee and avoiding some tax. So we have this form called a 1099/DIV, and so DIV stands for dividends. Okay, so when you get dividends, I love dividends, you love dividends, everybody loves dividends. Dividends are fantastic. You get paid some money for owning an investment. It's like a rental payment for owning investments. So box 1 and 2 are dividends, and I don't have any issue paying tax on dividends. The issue I have is total capital gain distributions, box number 2A. This is probably the reason why you're paying so much income tax in Tennessee and why Tennessee loves the investment choices you've made. So this is from Jason Zweig, The Intelligent Investor. And I love Jason Zweig. I've read a number of his books. He's one of the really good guys in journalism. But Jason Zweig wrote an article 2 years ago about how mutual funds insult their owners. And this was about not just the Tennessee tax, but the federal tax. You see, these capital gain distributions, they also get caught, they also catch you on the federal tax return. So what is a capital gain distribution? Let me just tell you really quick. It's not the buying and selling of your investment and you realize a capital gain. All it is that actively managed mutual funds, and if your mutual fund has a name of anything other than like Vanguard or, and some Vanguards are actively managed, or Dimensional Fund Advisors or some of the other more passively managed funds, what ends up happening is the mutual fund itself buys and sells, and tries to pick stocks. Then also you have redemptions of people taking their money out. Most people invest in actively managed mutual funds because they want to do great. And when the funds disappoint, they start pulling money out. Well, these two activities of generation of activity within the funds, even if you do nothing, creates a capital gain distribution, and you have to pay tax on it. So the capital gain distribution could be up to 23.8% on your federal tax return, 23.8%, and then another 6% on your Tennessee tax return. Most other states capture this as well, but for Tennessee, it's one of those things where we just feel like we don't have an income tax, so why should we have to pay income tax? Well, it's dividends, interest, other types of passive income, and these capital gain distributions. I've seen people have to pay hundreds and thousands of dollars this tax season because of capital gain distributions. And the good part is you don't have to. Now you have to figure out a way to get from where you are today to get to a passive portfolio, because you don't want to just sell everything. That will create real capital gains. And so you have to do it in a very, very methodical process. But if you need help, that's what we're here for. But hopefully at least you've learned why you pay so much Tennessee income tax. It could be because Tennessee loves the types of investments that you have. Thanks so much for watching. I'm Kevin, a CPA that does financial planning. Again, thanks.